The single biggest reason why you should invest in startups is because of the insane ROI potential. But that doesn't mean you should go ahead and invest all your money in startups, let alone even a fraction of your money. In this video, I'm gonna break down 5 of the pros and 5 of the cons of investing in early stage startups. So if you're not familiar, investing in a startup simply means you're investing in a company that is still private. You're not doing it on Robinhood or one of these other investment apps of a company that's traded on the New York Stock Exchange. No, none of that stuff. You're basically investing in buying early ownership in a company that one day has the opportunity and the potential to become something massive. If you were one of the early investors in Facebook, Amazon, Tesla, Google, Apple, any of these companies, if you just invested $1,000 or $5,000, you would have hundreds of millions of dollars. Now that's an extreme example. There's other examples of this insane ROI potential where maybe you invest $500 and that's worth $50,000 in 10 years from now, right? So that is some of the opportunity that you have with this insane return on investment potential. And that is normally the primary reason that attracts people to invest. Now, a big misconception is that you need a lot of money to invest in early stage companies. And people think you need to have at least $25,000 or $100,000. And that has been true in the past. But today, due to different regulations and different ways that companies can raise investment, you can actually invest in a lot of early stage companies that are private, startups online, for as little as $100. There's a lot of different platforms out there that you can do this: Republic, Start Engine, WeFunder, AngelList, Seed Invest. I actually talk about this a lot in my new book, How to Invest in Startups, A Beginner's Guide to Angel Investing. This is linked down below. And if you guys are new here, what's going on? My name is Ferris, serial tech entrepreneur, Forbes 30 under 30, YouTuber, all that magic. And I'm also the founder of the Startup Investor Academy. So if you want to learn how to invest in startups step by step, and you like the analogies and the methodology that I share here in this video, make sure you check that out. If not, at least subscribe. So thank you for your time. Let's go ahead and get right into number 2 pro is that you get to invest in what you believe in. I think this is so cool. As an early stage investor and also as an entrepreneur myself, I get to meet with other great entrepreneurs. I want to invest in what I believe in. I believe in these entrepreneurs and I want to get in on the ground level and really back the next big idea, the opportunity to change the world. It sounds really fluffy and it sounds, mushy, but that's actually what you get to do. When you invest in a startup, you are literally investing in something that is going to change the world. Or at least that is the hope and that is the belief and that is the dream that you are being sold on. If you're investing in Apple or Google, right? These companies have kind of already changed the world. Maybe they come up with some innovative thing in the future, but the reality is most of the innovation has already happened. Google search and even YouTube hasn't really changed in the last 15 to 25 years. Think about that for a second. So when you're looking at startups on these different investment sites, you can invest in what you believe in. Now, the third biggest pro, I believe, is that you get to diversify your portfolio. This portfolio diversification is awesome if you already have an investment portfolio. If you already have, stocks, you have bonds, you have real estate, there's crypto. You got to add some startups to the mix just because of the opportunity for these insane outsized returns, that ROI potential. That's why it's smart to diversify your portfolio. Number 4 pro is that you get in-depth learning opportunities. You don't really get this when you look at a publicly traded company, right? You can look at a company like Apple or Google, you understand their business model. Maybe you think they're a fair valuation. If you're more a value investor for the long run, you're looking at their price to earnings, their PEG ratio, all these different things. And that's how you can decide whether or not to invest in a company. Maybe you like the leadership, etc. When you're investing in a startup, you really need to do a little bit more homework because if you're not doing an in-depth analysis, you're not doing due diligence, it's very easy for all of these things to kind of go over your head, and you invest in something that has a much lower likelihood of getting outsized returns and a much higher risk of completely failing and taking your money to absolutely nothing. Zip, zilch, nada. So if you put in the time and you actually do the due diligence, you can improve your odds significantly of making a smarter investment decision. Now, this is not financial advice. I'm not your financial advisor. This video is for entertainment purposes only, but keep that in mind. When you look at a public company, all the information is listed. It's really easy to see everything about it. There's a track record. They have 20 years of operating history. When you're investing in a startup, you don't really have any of that stuff. So it's really important that you pay attention to doing that due diligence. And the fifth pro is that you get early access or exclusive perks to the company. I've invested in a lot of different companies and I've been able to get exclusive perks to the company because I am an early investor. For my own personal company, I've raised 3 different rounds of online capital, millions of dollars, but we offered perks for these early investors, whether it was a lifetime subscription for free to our mobile app, investor swag, early access to different things, stuff like that. So when you invest in a company, especially if it's direct to consumer, even B2B, you might be able to get some access to some cool swag that you might not have gotten otherwise. So those are just 5 of the pros. Now let's talk about the cons, because I think this is potentially more important because you're probably already sold on it, and that's probably why you're watching this video. So let's go ahead and get into these cons. We already talked about high risk. Literally your money goes to zero. So high risk, high reward, I think that one's pretty easy to understand. You invest $100 or $1,000 or $100,000 and you should be willing and okay with that money going to nothing. If you're not okay with that, you should not be investing in startups. There's plenty of other ways that you can put your money, keep it under your mattress, put it in a savings account, put it in the S&P 500, go buy a house, go put a down payment on a house, whatever. There's so many other things you can do that are lower risk, potentially lower opportunity, but they're lower risk. The second con is what I just basically talked about. You have a binary outcome. This is a good and a bad thing. So what that means is you're either going to make a lot of money or you're going to get nothing. And most of the time, you're probably going to get nothing. And that's okay because that's how the game is played. You don't invest just once. And I talk about this a lot in my book and the Startup Investor Academy and other videos I've done. But really, you want to spread your chips out, and there's a strategy in how much you invest and when and why and where and whatever. But it really is a binary outcome. So if you only make one investment and you put all your money in it, you should probably assume you're going to lose all that money. But instead, if you diversify, you can mitigate risk significantly, but you just have to be aware that there is a binary outcome. And if the company ends up just returning your money, that's actually not good because you may return the money, so you have a 0% internal rate of return over a 10-year period, which basically means you lost money because inflation was eating away the value of your money. So you would have been better off just investing it in the stock market, or let alone put it in a savings account that gets 2% annual interest. You would have made more money than if you put it inside of a startup. Number 3 is the lack of liquidity. Like I just mentioned, there is a lockup. Once you invest in a startup, there is a secondary market that's a little bit more in depth. I'll save that for another video, or you can also learn about it in my investing course. But the reality is, you're not ever going to see your money unless the company is sold or goes public. In which case, in that small scenario, you will probably have ridiculous gains. But that's it. There's no in between. So really, you don't have any liquidity, meaning you have no access to the money that you invested. So you only invest what you're willing and able to completely lose. The fourth is that it takes a lot of time to research. I mentioned this as a pro, is that you have in-depth learning opportunities. That really just means you're going to spend time researching. So depending on how you look at it and your mindset, you're either going to spend a ton of time and you're going to enjoy the process. You're going to become a better business person, investor, entrepreneur, all that cool stuff. Or you're going to look at it as a time suck. Because the reality is there's a balance. If you're only going to invest $100 and you have to spend 10 hours, if you're evaluating it on a simple ROI of your time, it's not worth it. But if you value what you're going to get, then it is an in-depth learning opportunity. Even the $100 is kind of just negligible at that point because you're really valuing from what you learned from that experience. But if that's not how you're looking at it and you just want to throw your money somewhere, yes, it will take time to research, and that's definitely a con. And then finally, you need capital to get started. If you have no money, I don't even know why you're watching this video. This video is for people who are serious about learning how to invest in startups, or maybe you're building up a stockpile of cash because eventually you want to get into this and this is your dream and you aspire to be there. If you are privileged enough to make it this far in the video, thank you for your time, but just keep in mind that this is something that you do need capital. Maybe it's only $100, but if you only have $100 to invest in a startup, you should still not invest in startups, because if all you have is $100, you're better off investing in yourself and your education to go and make more money. Because if you don't have, a few hundred or a few $1,000s per month extra after paying all your expenses, after investing in your 401k and your retirement and paying all your bills and all that stuff, then if you have a few hundred or a few thousand or $10,000 or $100,000, then you should be looking at investing in startups. So what that really means is that most people can't do this. You got to remember, you are in a very select group of people if you made it to the end of this video and you have the opportunity to invest in a high risk, high reward asset class? I mean, how amazing is that? You know, give yourself a pat on the back, but don't fluff your ego too much, because the reality is there's a lot of work and you got to spend the time to research. Think of it as a learning opportunity. That's just my perspective. Let me know what you guys think down below in the comments. While you're down there, make sure you like and subscribe to the channel, and also check out the Startup Investor Academy. Thanks for your time, and I'll catch you guys later. Peace.